everybody. This is Alan Ellman, the blue collar investor, welcoming you to this BCI podcast number 87, titled Bear Market Concerns and Our Option Selling Portfolios. Crafting our strategy during challenging market environments. One of the things that differentiates the BCI methodology from the others is that we can structure our trades based on what's happening today. So our covered call writing and selling cash secured put trades will differ in bull market environments versus bear market environments versus normal and neutral market environments. This particular podcast, we're going to discuss what we can do in challenging or bear market conditions. So let's have a look at some of the management techniques that I'll be discussing in this podcast. First of all, selling in the money calls and deep out of the money puts. Second, using low beta stocks. Third, using low implied volatility stocks. Now, these will give us lower returns, but reduce the risk in challenging market conditions. The use of exchange traded funds, which generally have lower volatility than individual stocks, although there are exceptions. The purchase of protective puts, so that if the price of the stock declines dramatically, we have a floor on the amount that we could lose. And finally, the PCP, or put call put strategy, sometimes referred to outside the BCI community as the wheel strategy, where we use a multi-tiered option selling strategy involving both selling cash secured puts and covered call writing. Let's get started. First, selling in the money calls and deeper out of the money puts. When we use in the money call strikes with covered call writing, what we're doing is we're lowering our cost basis greater than at the money and out of the money strikes because there's an intrinsic value component to the option premiums. So this represents an insurance policy that's paid for by the option buyer, not us, the option seller. Let me give you an example. Let's say we sold a $30 call option when the stock was trading at 32, and let's assume a premium of $3. Well, we can't count that entire $3 as profit because we're losing $2 on the sale of the stock. We bought it at 32 and agreed to sell it for 30. Now, if you put that into the multiple tab of the Ellman or any of the BCI calculators, you would see the initial profit is 3.3%, and that's time value profit, and that's protected by the intrinsic value of $2 or 6.25%. So what that means is we're guaranteed a 3.3% 1 month return, since I usually use 1 month expirations, as long as share value does not decline by more than 6.25%. So you could see the value of in the money call strikes with our covered call writing trades in challenging market conditions. Now, similarly, if we use deeper out of the money cash secured puts, much lower than current market value, we have additional protection because those options will not be exercised unless the price travels all the way down to that deep out of the money put strike and then below it. A break even is the put strike minus the put premium. So you have much greater protection by going deeper out of the money rather than just simply out of the money. The next technique is to use low beta stocks. Now, our premium watch list that we provide to our members do give these beta stats, and basically that represents the historical volatility compared to a benchmark, usually the S&P 500. So the lower the beta from a historical perspective, the less the risk. Now, I would consider this a secondary parameter, not as important as the implied volatility of the stock, because that's implied volatility is more forward-looking, whereas beta is more backward-looking or historically looking. Another technique is to use options with a lower implied volatility. Now, since our premiums are directly related to the implied volatility, of the underlying security, we would have to also lower our return goals. As an example, I usually like to achieve 2 to 4% a month for my initial time value returns. I would then lower that to 1 to 3% if I'm using lower implied volatility securities. So that means I am susceptible to lower risk and my premiums will be less than I had been using more standard type of stocks and ETFs. Next technique, we're going to use exchange traded funds instead of stocks. Since these are baskets of stocks, some are going up, some are going down, as a whole, these securities tend to have lower implied volatility than individual stocks. Now, there are exceptions to that. I'm talking in general terms now. Now, our weekly ETF reports that we do for our premium members will also give IV stats so we can make sure that the implied volatility of the securities we're using aligns with our personal risk tolerance as well as our overall market assessment. Now, here too, I have a tendency to lower my time value return goal range, perhaps something like 1 to 2%. Another technique, buying protective puts. This is known as the collar strategy when that's combined with covered call writing. So the put gives us the right but not the obligation to sell our shares at the strike price. Once again, now we buy the stock and then we write a covered call, usually at a higher strike, so an out of the money covered call, and then buy a protective put lower than current market value, and that for a put that's also out of the money. Here's an example. We buy a stock at 48. Let's say we sell the 50 out of the money covered call for $2 and buy the 45 out of the money protective put for $1. So our net option credit is then $1, 2 minus 1. Our option credit is cut in half by purchasing the protective put, which will give us protection if there's a catastrophic drop in share price from current market value of 48 to below the 45 put strike. Now, if we fed this information into the BCI collar calculator, we would get the following results. The initial time value return is 2.08%. This is for a 1 month return. Now, if the price of the stock goes from 48 up to and beyond the 50 strike, that adds additional return because we have share appreciation. And that max return is 6.25% as displayed with the BCI collar calculator. Now, what if the price of the stock drops below that put strike of 45? Well, then our maximum loss is 4.17%. So just to review, our initial time value profit is 2.08%. Our max return is 6.25%, and our max loss is 4.17%. So all in all, it's a low risk trade. And remember, we're only using stocks that have passed our rigorous screening process. The final strategy in challenging markets is the PCP strategy. And that's where we sell out of the money cash secured puts before entering a covered call trade. So when we sell that out of the money cash secured put, we will not purchase the stocks unless the price drops below the put strike. In essence, buying the stock at a discount compared to when we initially sold that out of the money put. If and when that put is exercised, we buy the shares at a discount. Now we own the shares and we could sell a covered call. Out of the money is more aggressive, in the money is more defensive. If it's not exercised, we write another covered call. If and when it is exercised, the shares are sold, and now we have the cash then to secure another put. And so it goes. Each month, we're either buying a stock at a discount or we're generating cash flow. Let's summarize. One of the advantages of covered call writing is that it can be molded to meet the challenges of what's going on today, the current market conditions. Now, an educated option seller, which defines the BCI community, will change the strategy approach based on what's happening today. One size does not fit all. We must evaluate the overall market, chart technicals, and understand what our personal risk tolerance is. That will guide us to how to structure our trades. Before I leave, folks, I want to remind everybody about all of the free resources we provide to you, the BCI community. Just go on our website, www.thebluecollarinvestor.com. Look for that free resources link on the top black bar of our web pages. Check out our Beginner's Corner tutorials. It's free. You can download the PowerPoints. One is for covered call writing. One is for selling cash secured puts. And boy, do we have a lot of educational products for you in the BCI store. We have online video programs, calculators and spreadsheets, ebooks, soft and hard covered books, trade planner, online mentoring programs, and so much more to help you master the strategies of covered call writing and selling cash secured puts. Ladies and gentlemen, thank you so much for taking the time to listen to this BCI podcast number 87, Bear Market Concerns and Our Option Selling Portfolios. I hope that you not only enjoyed this presentation, but I also hope it puts some cash in your pockets. As always, this is Alan Ellman, the Blue Collar Investor. Take care, everybody.